Hello friends, in my video dated 28th of October this year, I had listed my concerns about banking and financial sector services being a weak spot for the markets. In the inset box, you can see what I mean, how the bank Nifty has underperformed the Nifty 50 where relative returns are concerned over a month, 12 weeks and then a 20-week time frame. So if you're a bank Nifty or a banking and financial sector services investor, your basically returns would have been compressed as compared to other sectors out there. Of course, this is the spot price and the cost of carry is not factored in the calculation, or your returns would be even lower. Remember, the two indices are like two wheels of the bicycle, and if both of them are going to move in divergent directions, it's not really good for the markets and the bicycle can possibly topple. It's pure and simple physics. It's as simple as that. So you want both the indices to go in the same direction, or the market can get extremely volatile and might even topple. The reason being, the banking and financial sector services have approximately 35% weightage in the Nifty, and if this sector is likely to come down a little, it will have a drag effect on the Nifty also. Let's remember that we are brain warriors. We win with our ideas, and ideas that are backed by data and pure logic. So the logic is in front of you. Now, last week, two things have happened that should worry bank stock investors. Number one, the RBI finally acted upon the concerns that I have been putting forth in our free Telegram channel in detailed editorials that I have been writing to you about. Retail unsecured loans, personal loans, credit card debt, and these are basically high risk, high return earning loans for banks. So banks have been being a little more liberal in granting these loans, and the RBI has red flagged this, plus what I told you in a recent video, evergreening of loans. Do watch the earlier video and you'll get what I mean. Now, on my Telegram channel, I've written about the fallout of the rising cost of funds on interest rate sensitive sectors, which is banks, NBFCs, companies and sectors that are dependent heavily on EMI based selling, and companies that are nursing a whole lot of debt on their balance sheets. I've been telling you this since months. Now, do remember that the Bank Nifty has, for a reason, delivered negative returns over 4, 12 and 20 week period. If you're an actual real world trader, you would know, because your trade book would be giving you negative rolling returns, both absolute and rolling returns. Now, it's easier to be brave when you have no exposure, but when you have exposure, it's time to be careful out here. Now, the CAR, or the capital adequacy ratio, and the risk-weighted provisioning system for banks and NBFCs has been raised from 100% to 125% for personal loans as well as credit card outstandings. Not credit card limits, outstandings. What does it very simply mean? In plain speak, in plain English, I'm a bank. You are a personal loan borrower from me. I give you 10 lakh rupees in personal loans because it's an unsecured loan. You offer me no collateral. I'm taking a bigger risk as a bank. I will charge you higher interest. High risk, high return. Pretty simple. But the RBI says that this sector is more vulnerable to delinquencies, a very polite term for defaults. So it's asking the banks to take a risk-weighted approach and say not 100% but 125% provisioning. What does it mean? It means that banks will have to set aside higher amount of capital in risk-weighted capital adequacy ratios, and it also means blocking higher amount of capital to run the same loan book. Obviously, the return on investment will be smaller because the bank is investing more money as provisioning and the capital adequacy, and therefore cost of capital will go up. Some banks might even resort to raising money either by way of deposits or by way of tier 1, tier 2 bonds. But the fact remains that their borrowing cost will go up. And these costs will be passed on to the borrower. I've been warning you repeatedly about banking and the particular case in point in SBI. Very simply put, SBI is approximately, if not more, at least 60% of all banking in India, both in terms of turnover or assets or loan book, etc. So on one hand, you have SBI, on the other hand, you have all the other banks. SBI is still bigger. Look at where the stock price is of SBI since the last few months, and you'll know what I mean. I've been encouraging my online family about learning all you can about cost of money, about bond markets and bond convexity, and I've been telling you that you must read books by Dick Stoken and Russell Napier, who are some of the finest authors out there to teach you about the implications of rising and falling interest rates and cost of money on equity markets. That's pretty important because cheap and easy availability of money is like mother's milk to a bull market, and when you turn off the money tap, what can happen? Of course, with a lag, nothing needs to happen on Monday morning itself, but the impact felt will be palpable to real world traders, people who actually trade. So please do take the time and learn all you can about it. Markets, like I said, don't have to necessarily fall immediately, that is, but the rate of climb, the rate of ascent, or the rate at which it is rising can definitely slow down, if not even come to a crawl. The other aspect is, I told you there were two events that occurred. The second event that occurred last week is the Indian foreign exchange reserves fell by $462 million to $590.32 billion in the week ended 10th of November 2023. Now, the Indian forex reserves hit an all-time high of 645 billion in October of 2021. That is a little over 2 years ago, and they've been subsequently softening and falling because the RBI has been resorting to intervening in the forex markets and trying to cool off the rising dollar, and therefore the reserves have been coming down somewhat. Now, what has happened is the impact of the falling reserves was seen on the rupee, which hit an all-time low versus the US dollar before kind of settling marginally higher. The chart on your screen here, the weekly chart, shows a small range for the last 2 weeks. Now, this is resembling a coiled spring. When you compress a spring and keep it down for a while and then suddenly let go, the spring expands. Now, which way will the price break out? Will it rally or will it fall? Time will tell us, but the rupee at an all-time low against the dollar is not something that is very welcome. Do note that the US dollar index, or the DXY, is falling sharply since the last few trading sessions, and our only hope is that maybe the weakness in the dollar will save the rupee from further declines. Why am I worried about the rupee? Because if the rupee gets weaker against the dollar, landed price of imported goods and services will be higher because the dollar is the invoicing currency in most trades, and we will suffer from what is known as imported inflation. And that could have an even more adverse impact on household savings because higher inflation means lower savings, lower deposits to banks, and higher cost of borrowing for the banks. And typically what can impact imported prices of goods are fuels, pulses, cooking oils, electronic goods. These are just to name a few. So we don't really want a weaker rupee with a lower purchasing power. We want a stronger rupee, right? So, which is why you need to watch the USD INR, you need to watch the Indian 10-year benchmark bond yields along with the equity indices to get a handle on what's happening. Do remember banking and finance has almost 35% weightage in the Nifty. So if this sector is going down, it will pull the index with it. Also remember that the bank Nifty is giving you lower relative returns as compared to the Nifty 50. Friends, let's now go back to our regular studies which we tackle every week, and coming up on your screen is the weekly market roundup window, which tells you that it was the Nifty which led the way up, but the bank Nifty continued to fall. I've been telling you since months that the banking sector is the Achilles heel of the market, and I like told you on the video dated 28th October that banking is worrying the bulls. Now bank worries are back again, and how? Now the US dollar index fell 199 basis points, and that had a boosting impact on bullion. Gold and silver went up because the dollar is weak, and a weak dollar means higher commodity prices. It didn't really work out well for crude oil and natural gas, because I've been writing very detailed editorials on my Telegram channel debunking the super cycle theory. My trolls notwithstanding, since the last 2 years I've been debunking this theory, and I've been getting extremely amusing feedback on this hypothesis. Not only do I say that energy will not see a super cycle, but we are now headed towards pro-cyclical hysteresis in prices, and I've recorded a podcast on our free Telegram channel about what pro-cyclical hysteresis is in prices. Now the USD INR also fell 7 basis points, but look at how the Dixie has fallen almost 200 basis points, but the USD INR has fallen only 7 basis points. So in relative terms, the rupee has weakened against the dollar. The Indian 10-year benchmark bond yields have gone down by 9 basis points, and that tells you that bond prices have risen marginally. That saved the bank Nifty from even deeper declines. The market capitalization on the NSE went up 2.23%, which means the broader markets were still bullish and optimistic. The US headline indices were up approximately 2% each, and that provided tailwinds to the Indian markets. Friends, I now come to our in-house exclusive indicators, and I start with MWPL, or market wide position limits. Now these are limits that are utilized by traders as compared to the limits allowed by SEBI. Last week, the third week after the derivatives expiry of the October series, the MWPL has risen to 38.59. Now that's the highest after September 2023. So for a change, MWPL has gone up. It was plumbing lower and lower, but it now has risen for the first time after the third week of September. So risk appetite to that extent has gone up marginally. Now friends, I come to the stock and index futures turnover. This is the total of all 4 trading sessions last week. Do remember last week was shorter, and therefore the turnover was naturally marginally lower. But that was expected due to the festivities. Let's take a look at the advanced decline ratio here. And in spite of the fact that the Nifty has gained 1.58% as represented by the red line, the advanced decline ratio has come down to 1.07. Now here again, it's an average of all trading sessions of the week. So for every 100 losers, there were only 107 gainers. The bulls have just about managed to latch on to their buying conviction by a small margin. As long as this ratio remains above 1, I think the bulls still have a fighting chance of reviving sentiments. Friends, I now come to the prompt month basis. What is basis? It's the premium or discount prevalent on the futures, the front month futures. Now, the Bank Nifty basis has contracted, which tells you that there's been selling at higher levels. But on the Nifty itself, the basis has gone up to 74.70 from 57.30. Now that indicates short covering. Short covering not only cushions declines, but it also causes a rally during falling times. So this divergence tells you that there's selling on the Bank Nifty and buying on the Nifty 50. Do remember how over a 4, 12 and 20 week time frame, it is the Nifty which has given you positive returns and the Bank Nifty is giving you negative returns in the inset box. Friends, I now come to our exclusive in-house indicator, the impetus, which you've trusted for over 2 years now. And what you're seeing is that the Nifty 50 went up last week and the impetus reading, which is as indicated as a blue line, also rose marginally. So there was somewhat improved momentum based buying on the Nifty, whereas the Bank Nifty fell, but the impetus also fell, which means there was no forceful selling on the Bank Nifty. Now that is an indirect plus point, indirect relief point. Because even though the market has fallen, there was no undue or excessive selling pressure. Will it continue? It might. I update this metric on our social media accounts for free every day post-market, so do join me there. My contact details come at the fag end of this video. Friends, I now come to our second exclusive in-house indicator, the Lift Weight Thrust Drag Index. You've trusted this for over 2 years now. Note how the Nifty has gained 1.58% on a week-on-week basis after being negative in the prior week. And the LWTD indicator has also risen to positive, that is 0.32, after being negative minus 0.04 in the prior week. What does it tell you? That I expect, relatively speaking, as compared to the prior week, there to be marginally improved fresh buying support and even short covering in case of declines. So there doesn't seem to be excessive panic in the markets, but if at all there is a fall, it could be a slow slide. Friends, our exclusive indicators done. I now come to the bond markets, which you know are very close to my heart because I tend to cover bonds before equities in my reports and videos, because this is a market that funds and fuels the other asset classes. What I showed you was that the Indian bond yields had fallen last week. Now, if you see the weekly chart on your screen, this is the fourth consecutive week of declines. But the bond prices are not below the 7.10 threshold, nor are they above 7.50 or 7.60. So neither am I going in for gilt funds, which I will go in the case of bond yields falling below 7.10 or even 7.00. Nor am I laddering, which I would do if yields go above 7.50 or 7.60. So what am I doing? I'm sitting on the fence. I'm keeping the powder dry, which means I'm keeping the checkbook ready, money in the bank, but doing nothing as of now. When will I do anything at all? The first you will hear about it is on our free Telegram channel. So do take the effort of joining me there. Friends, the bond market's done. I now come to the Bank Nifty, and what you are seeing is on the daily chart on your screen. It's fallen 0.54% and it registered losses on 3 out of 4 trading sessions. And the price is now below its month-long moving average, which itself is pointing lower. So the short-term outlook appears to be under pressure. Do note the head and shoulder formation, which is indicated with a blue color neckline. The price has finally closed in the week below the head and shoulder neckline after attempting to rise above it. Now that tells me that the Bank Nifty, at least in the near term, appears to be under pressure. Now let's go to the weekly chart of the Bank Nifty. What you're seeing is a bearish engulfing pattern because the bearish red candle has completely overshadowed the prior week's small bullish candle. Here again, you can see that the price is below the neckline and the price is also below the bullish wedge formation, number one. Number two, it is also below its 25-week exponential moving average, which is a proxy for a 6-month-long holding on cost of an average buy and hold retail trader. So the medium-term outlook of the Bank Nifty also has turned weak. In short, it's time to be careful out there. Do remember, I've been telling you that the Bank Nifty returns are lower relatively as compared to the Nifty 50 returns. In the week before last, the Bank Nifty was number 3 on our most volatile counters list as per statistical beta rankings that we maintain in-house. It fell 2 notches to number 5. That tells you that relative volatility or statistical beta fell last week and the challenge level has come down slightly, partially because individual stock volatility went up. Last week, I advocated an estimated range between 44,900 on the upside and 42,725 on the downside, which held perfectly well. In the coming week, I estimate a range between 44,675 on the upside and 42,500 on the downside. Friends, please take advantage of our free pivot points on all 3 indices on a daily, weekly, and monthly basis on our free Telegram channel. It'll help you trade as an option and futures trader, option writer, option buyer, or even a swing trader in futures. It's updated every single day. So let's connect out there. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 1.58% on a weekly basis and rose on 2 out of 5 trading sessions, as the daily chart on your screen tells you. The price is above its month-long moving average, which itself is turning upwards, which tells you that relatively speaking, the Nifty is better poised as compared to the Bank Nifty. I've been telling you the relative returns of the Nifty are also better than the Bank Nifty. The price has closed up above the 19,557 level, which I advocated last week, and it must stay above this for the bulls to have an upper hand. The weekly chart on your screen tells you that the price has closed comfortably above the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. The medium-term outlook is positive. The 25-week exponential moving average itself is headed upwards, and therefore the Nifty relatively speaking, is better poised as compared to the Bank Nifty. Is the Nifty out and out bullish? I would not say that with a great degree of confidence without watching what happens to the banking and financial sector stocks. Why? Because these stocks have approximately 35% weightage on the Nifty itself, and therefore weight of evidence and statistical logic tells you that you must watch every component that goes into making the Nifty. And if any of these components are weak, and banking and financial is the biggest component, then you should not be foolhardy and stick to bravado here. Staying above the 19,875 level will keep the bulls firmly in the driver's seat, because that is a recent resistance area, and clearing that resistance will be a sign of optimism. Friends, in the week before last, this index was number 10 on our statistical beta list of most volatile counters. It fell 1 notch to number 11. So volatility, relatively speaking, fell a little bit, also because individual stock volatility went up. Last week, I advocated an estimated range between 19,800 on the upside and 19,050 on the downside. The high was 19,875, which is 75 points higher than where I estimated it to be. The coming week is likely to see an estimated range between 20,125 on the upside and 19,350 on the downside. Here again, I suggest you watch the daily, weekly, and monthly pivots of the indices, updated free every day on our Telegram channel. It will help you as a futures and options trader, option buyer, seller, futures, intraday, and swing trader, etc. Do make use of this free feature, please. Friends, I now come to the last bit of statistical analysis, wherein I estimate the retail risk appetite by their footprint and turnover contributed in the 4 segments of the market. What you are seeing is index futures turnover as represented by a blue line has stayed constant or gone up marginally. Stock futures turnover, as indicated as a red line, has also gone up marginally, which means risk appetite in the futures segment rose. Index options turnover, which is indicated as a green line, has fallen sharply, and this is the lowest risk instrument in the market. So lesser turnover means traders are focused on higher risk instruments. For that matter, stock options, which are relatively speaking more volatile than index options, saw a smart uptick in turnover by almost 35 basis points. So, net net, I would say that risk appetite was higher in the week gone by. Friends, I now come to my trading strategy in the week ahead, and I've been advocating theta decay in interest rate sensitives like banks, NBFCs, sectors that are completely dependent on EMI based sales and highly leveraged borrowed corporations. Now, that has paid pretty well, and that too big time last week. I would like to stay with that strategy, and as long as something works, why not stick to the winning formula? I will particularly focus on PSUs, which is public sector units, and public sector banks, which is PSBs, because these might give exaggerated price moves and traders will find the volatility to be opportunistic for trading. Oil and gas have worked out beautifully well because I've been telling you that not only is there no super cycle in oil and gas, but there is pro-cyclical hysteresis in prices, and I expect deleveraging and declines. And there you have superlative falls in both. But there is likelihood of a dead cat bounce or a technical bounce, because remember on Friday, OPEC came out with a statement saying that we might resort to another cut of 1 million barrels a day so as to stabilize the prices. Of course, they've not said stabilize the prices in so many words, but there are some things that are better left unsaid. So do give it some time, let prices stabilize or rise a little before going out there for the kill. You also have expiry of natural gas contracts coming up, so you'll have to be careful, and higher strike prices will open up for trade once the new series starts. So more opportunities available for theta traders. A word of caution here, just keep an eye on the cost of carry for backwardation in the FAR month futures series. If at all that starts, we'll need to have an update or a review in theta decay strategy in the weeks going forward. I would suggest you trade light in the first half of the week and then pick up momentum in the second half, because by then it would be amply clear as to where banking and financial sector stocks want to go, and that would give us more clarity on where the Nifty itself will possibly go towards. Friends, let's focus on staying ahead of the crowds and making a good living in the week ahead. I thank you for your patience in being with me in this video. Till we meet again, this is Vijay Bhambwani signing off for now, not before reminding you to click like on this video and subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment segment, do let me know how you like our work. Also, help me reach out a bigger audience by sharing my videos with your friends and families and helping me expand the channel. Thank you for taking our channel to a 2.5 lakh, 250,000 views last week. I truly appreciate your viewership and your support. I hope you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.